Hey everyone, good morning and welcome back to the channel. Well, it finally happened. We just witnessed our very first negative 1% day in the stock market for the first time in almost 2 months for the first time since the 27th of March. The stock market dropped 1.2% last Friday, and right on cue, you see the panic headlines spreading everywhere. Millions of retail investors are completely losing their minds because they do not understand how money actually works. They treat the stock market like a giant casino, and then they wonder why they get absolutely scalped by Wall Street insiders. While the average person is running around screaming that the sky is falling, smart money is calmly looking at the macroeconomic data and executing a precise blueprint to build genuine financial freedom. Before we tear into the exact data metrics that you need to watch out for this week, let us do a quick pulse check because I want to see who in our community is actually serious about their personal finance goals. Do me a massive favor and drop a comment right below this video with your current age and the exact dollar amount you are realistically planning to invest every single month. I do not care if your target is $50, $500, or $5,000. Type it down in the comments section right now because tracking your hard numbers is the absolute first step to building long-term wealth. Seriously, pause the video, comment your age and monthly investment amount below so we can keep each other accountable as a community. Now, if you watched my last Sunday video, you already know that I explicitly told you I was starting a strategic position in MRAM. I honestly expected this position to take a little bit longer to play out than it did. However, we ended up 160% on this position within just a single week as MRAM's market cap surged from 400 million to well over 1 billion. We officially closed that position up 160% bank secured and cash locked in. That is exactly what happens when you follow a strict rule-based investing framework instead of chasing random social media hype. Today, I am going to give you a complete blueprint here as to how to tackle this market going forward because there is a massive amount of moving parts that you need to watch out for this week, from both a trading and a long-term investing perspective. First, we need to address the structural reality of the calendar because we are officially coming up on a historically bearish time frame. If you look at the historical data from May to October in midterm election years, the broader stock market tends to see a significant seasonal correction. The historical average for this specific pullback is minus 10 to 12%. However, I want you guys to recognize something incredibly important that the mainstream media is completely ignoring. If you look closer at the data charts, there are actually no years ending and the number 6 included in that bearish average. The historical years of 1986 as well as 2006 were actually highly positive years for the market. And obviously right now in 2026, we have a year ending in 6. Granted, that is a very small sample size to rely on, but it proves that you cannot blindly follow generic historical patterns without digging into the granular details. Historically, May to October in midterm election years can be a tough environment, but the data shows 2026 might just defy the standard bearish expectations. We also have a massive historic shift happening at the top of the central bank. The United States Senate just confirmed Kevin Warsh as the next official chair of the Federal Reserve in an incredibly tight 54 to 45 vote, which goes down as the most partisan confirmation vote in the entire history of the position. But here's the catch. Even though the confirmation is official, the precise date for Kevin Warsh being sworn in has not been set in stone yet because the final White House paperwork is still being finalized. Because of this administrative delay, the Federal Reserve officially named Jerome Powell as chair pro tempore until Kevin Warsh is formally sworn into the role. So Powell remains the de facto functional leader of the central bank for the immediate future. As I shared with you guys in my previous videos, the market historically tends to see a notable pullback during the first few months of a brand new Federal Reserve chair because big institutional players love to aggressively test the new chair's monetary policy boundaries. That is a major near-term risk factor you must account for in your portfolio. On the geopolitical trade front, we just had a massive high-profile summit between China and the United States. Representatives from China publicly stated that they reached a tentative agreement with the United States on specific tariff reductions and trade cooperation by committing to purchase a downsized order of American airplanes. But they also dropped a massive bombshell statement. They openly declared that even though the United States government technically allowed them to purchase the high-tech H200 artificial intelligence chips from NVIDIA, they are completely refusing to buy them because they simply do not need them. Now, I do not know if that is just empty political grandstanding from Beijing or a genuine shift in their domestic technology supply chain, but it creates massive underlying ripples. Speaking of NVIDIA, we have their highly anticipated corporate earnings report dropping this Wednesday after the closing bell. Personally, I fully believe that NVIDIA is going to deliver a massive beat on their earnings numbers and a massive beat on their total revenue numbers, which will likely result in another record-breaking historical quarter. But as always, the entire institutional market is going to be hyper-focused on their forward-looking guidance. If that guidance shows even a tiny scratch, you can expect massive volatility across the entire tech landscape. We also have the colossal SpaceX initial public offering coming down the pipeline, but that massive wealth event is scheduled for later next month. Now let us talk about how to actually trade and invest around these specific trends. I previously told you guys about utilizing a strict 921 exponential moving average crossover strategy on the high-flying AI build-out stocks, and I gave you a precise watch list of companies to track. By the way, I have compiled a complete updated list for you of every single stock that I am tracking from an AI build-out perspective. If you just click the link in the description below, I will send you that entire institutional grade PDF, absolutely free of charge. Make sure you click that link so you can see exactly what assets are on my personal radar. If you actually followed that moving average tip from my last video, just look at what happened with AAOI, which is a leading photonic infrastructure stock, by simply executing entries off the 921 EMA chart just last week. The stock ripped up an astonishing 53%. We saw the exact same technical setup manifest in ticker light, which is Lumentum Holdings. If you track that exact setup, Lumentum Holdings was up a beautiful 21% in a matter of days. Ticker Core, which is Coherent, another major photonic player, did the exact same thing, jumping aggressively right off the 921 EMA line. As I always say, your job as a disciplined investor is to take full advantage of a verified structural trend until that trend is officially no more. I do not care what the generic talking heads say about midterm election years. A lot of these hyper-growth infrastructure stocks are not even held inside the major SP 500 or NASDAQ indices. The current market cycle is completely obsessed with photonics and hard data center infrastructure. Look at Nebius, which just minted another fresh all-time high last week after cleanly bouncing right off that exact same 921 EMA support. If this structural trend breaks tomorrow, then yes, you immediately stop running the strategy because the trend is your absolute friend until the very end. But until those key moving average lines officially crack, you do not let your foot off the gas pedal. While the hardware build-out continues to run hot, we might also be witnessing the early stages of a massive sector rotation directly into software assets. If you look at IGV, which is the core software exchange traded fund, it has quietly broken out for a massive 25% gain since the 10th of April. I just completed a massive comprehensive investment thesis right up on ServiceNow. If you log into AlphaScope and analyze their core underlying free cash flows, their cash generated from operations, their EBITDA metrics, and their top-line revenue growth, it looks like a textbook linear graph. The fundamental growth numbers look almost too good to be true, but ServiceNow is a premier business that is consistently growing across every single vital financial metric you want to see as a long-term investor. Huge shout out to AlphaScope for making those numbers so incredibly scannable. Public signups for the platform are currently open at the introductory rate of $19 a month or down to just $16 and change. If you choose the annual plan, prices will be going up significantly in the near future, so make sure you lock in that low rate right now. If you want access to the absolute best fundamental data tool on the market, this software rotation narrative becomes even more compelling when you look at Microsoft, which looks like it is coiled and desperately wants to break out to the upside. This is true, despite the fact that Microsoft stock dropped slightly in after-hours trading last Friday, following the public regulatory announcement that Bill Gates had officially sold off the absolute remainder of his equity position. To be completely honest with you guys, that news is a total non-issue for my investment thesis. Bill Gates sold off the vast majority of his core Microsoft stock a long time ago. In fact, he famously missed out on the historic opportunity to become the world's very first trillionaire precisely because he paper-handed his Microsoft shares way too early before this massive historic pump into the mid-$500 range. So for me personally, seeing Bill Gates dump his final tiny remaining slice of shares means absolutely nothing. He already missed this entire multi-hundred billion dollar valuation expansion. If the broader market gives us a deeper macro dip on Microsoft or the tech sector, that dip is going to be an absolute financial gift. We have to remember that the SP 500 has been riding an incredible 7-week winning streak. Statistically, if you look at historical market data 52 weeks after an index achieves a 7-week winning streak, the SP 500 has never once been red. Now, I will always be 100% transparent and honest with you guys on this channel. If I do not know something, I will look you dead in the eye and tell you straight up. So is the SP 500 going to experience a massive standard correction right here? Personally, I do not think we are going to get a standard textbook market correction right now, just because we saw a single red candle on the chart last Friday, but I do firmly believe that the institutional market is going to aggressively test the new Federal Reserve leadership, especially after the first 1 or 2 official policy meetings under the new regime. So we will absolutely see a major market correction manifest at some point down the road. I just do not think it is triggered by last Friday's price action. The ongoing global artificial intelligence build-out is still in its incredibly early structural innings. There is still an immense amount of retail euphoria and institutional momentum left to play out. The market will very likely rotate heavily into lagging sectors like software before we face any kind of catastrophic bear market. That major structural collapse will likely delay until sometime in 2027. I do not see a major macro top forming until these software stocks completely fly into absolute hyper euphoria. First, However, we cannot ignore the massive warning signs flashing in the commodities market because crude oil is still stubbornly hovering at above $101 a barrel. The ongoing geopolitical crisis surrounding the Strait shipping lanes is completely unresolved. From a macroeconomic perspective, spending almost 2 entire months with global crude oil prices hovering around the $100 mark does not bode well for the financial markets at all. When energy costs remain sustained at these extreme levels, a painful economic recession becomes almost guaranteed at some point down the line because it completely crushes corporate margins and destroys everyday consumer purchasing power. We are already seeing the direct results of these sticky energy inputs in the latest inflation data blocks, which just printed numbers we have not witnessed since the height of the pandemic. The consumer price index just came in at a scorching 3.8% on an annual basis, marking its highest official level since May of 2023. Core inflation also heated up to 2.8%, crossing right above Wall Street expectations of 2.7%. But the absolute worst numbers of all were found inside the Producer Price Index report. Raw producer prices surged by an astronomical 6%, completely obliterating the consensus expectations of 4.9%. We have not seen wholesale producer prices this high since January of 2023. Core PPI printed at 5.2%, winding up way above the expected 4.3% marker. The longer these scorching wholesale inflation inputs remain sustained, the longer the Federal Reserve will be fundamentally forced to keep interest rates restrictive. I do not think the central bank has the stomach to actually raise interest rates further from here, but the statistical probability of another rate hike is officially higher than the probability of a rate cut. All of these economic chickens will inevitably come home to roost, and the ultimate macro breaking point will likely hit us hard in 2027. Our job as strategic investors is to recognize that plenty of profitable euphoria remains in the tank right now, and we must safely take full advantage of these massive trends while we can. But because this entire cycle will likely end very badly in 2027, you are going to have to play your positions incredibly tightly. You must have a predefined exit strategy, you must know exactly when to lock in profits, and you must know exactly when it is safe to put your foot on the gas pedal. If you want real-time access to my complete long-term macroeconomic analysis alongside my personal short-term swing trades, like our 160% win on MRAM, make sure to check out the links below. Go sign up for AlphaScope right now to completely transform your stock picking capabilities. It costs only $19 a month or $16 and change on the annual plan to put the best fundamental analysis tool in the game directly into your investing toolkit. Go ahead and grab that free AI Build-Out Stock PDF while it is still available. I look forward to seeing every single one of you inside the next deep dive video. Stay safe out there, market traders. Hit that subscribe button. Peace.